Welcome back to the deep dive. We grab your sources, lock them in a room, and pull out the essential insights you need.
Glad to be here.
Today, we're digging into a really interesting time capsule. The 1996 shareholders letter from Fairfax Financial Holdings Limited.
Yeah, this one's fascinating because 1996, well, it wasn't just a good year for Fairfax. It was explosive. Spectacular results.
Right.
And yet you read the management commentary, and honestly, they sound like they're bracing for, I don't know, the financial apocalypse.
Exactly. So our mission today is to unpack that paradox. How did this company manage this huge, aggressive strategic expansion, buying up companies, while at the same time taking this incredibly cautious, conservative, almost defensive stance in its investment portfolio?
Mm,
I think for anyone running a business or, managing capital, this letter is just a masterclass in preparing for that rainy day, even when the sun seems to be shining its brightest.
It really is a blueprint for discipline. That tension, the gap between the amazing profitability they reported and the deep, almost philosophical warnings they were issuing, that's the core of the whole thing.
Okay, let's get into it then. We really have to start with the results for 96. The scale is just, well, staggering.
Yeah.
We're talking a return on average shareholders' equity of 21.4%. That just demolished the TSC 300's return, which was about 9.1% that year.
Absolutely annihilated it. And, it wasn't just that. Net income jumped 72% to over $150 million.
Wow.
Earnings per share were up 57%. And the stock price, it nearly tripled to $290 a share. I mean, those are the kind of results that usually lead to big celebrations.
You think? Yet almost immediately, management slams on the brakes. They actively try to curb shareholder excitement.
They do.
They caution that this success wasn't, and I'm quoting here, based on some vision statement or long-term plan. They actually said it was just reacting to a phone call back in December 95. It sounds almost accidental.
It's like the ultimate displays humility or maybe a reality check. They're actively trying to manage expectations downwards. They say, point blank, there's no way the results in 1996 can be extrapolated into the future.
That's pretty direct.
Oh, yeah. They literally suggest they might not make any acquisitions in the next 5 years. This is clearly a management team that believes in under-promising, maybe hoping to over-deliver, and constantly guarding against, getting too complacent.
And a really key part of this defensive thinking is this unusual financial cushion they built up, $193 million in what they call negative goodwill. That works out to about $18 per share.
Right.
Now, for listeners who aren't maybe deep in insurance accounting, what exactly is negative goodwill? Why is it so significant here?
So negative goodwill is basically the opposite of what you usually see. Usually you pay a premium over book value when you buy a company. Here, Fairfax bought companies for less than their stated net book value. They explicitly call this an after-tax reserve. So it means they weren't just buying assets, they were buying them cheaper than the balance sheet said they were worth. It's like baking in a hidden profit margin right from the start.
So it's like extreme financial discipline right out of the gate. They've got a cushion before they even write the first policy.
Precisely. It's a pretty unusual way to signal both strength and caution at the same time. They're building a moat around the acquisition immediately.
So they had this cushion, but they weren't just sitting around. They spent 1996 growing and growing aggressively. Where did they put that capital to work?
Well, they made two really significant strategic acquisitions in the global reinsurance market. There was Odyssey Re, which was mostly focused on North America, and then CTR, which gave them a truly worldwide footprint. Offices in Paris, Singapore, Tokyo, New York. This was their big push onto the global stage.
And the sources say this immediately vaulted the combined group, Odyssey Re and CTR, into the top tier of U.S. reinsurers, writing over $500 million in net premiums.
That's right.
And their stated goal wasn't just grab market share at any cost, it was underwriting profitability.
Exactly. But the financing side of this is just as interesting as the deals themselves. To pay for this roughly $500 million expansion, they did issue shares, raising about $300 million.
Okay.
But what really stands out is their debt strategy. They tapped the 30-year U.S. bond market for the first time, issued U.S. $125 million in unsecured debentures.
Why is that specific time frame, the 30-year bond, such a big deal?
Well, getting access to the really long end of the debt market, 40 years, it's a massive signal of institutional trust. It means investors are willing to bet on your company's stability for, 3 decades.
Right.
And the letter points out only 9 property and casualty companies in the entire U.S., and only Fairfax in Canada, had 30-year bonds outstanding then. It shows the bond market really believed in their financial strength, even though their track record as a global reinsurer was basically brand new.
That's a powerful endorsement, regardless of maybe what rating agencies were saying at the time. But, rapid expansion, especially in reinsurance, it always comes with big risks. The letter doesn't hide this, does it?
No, not at all. They're very transparent. Both Odyssey Re and CTR came with significant long-tail liabilities, the classic asbestos and environmental claims.
The scary stuff.
Exactly. And also substantial reinsurance recoverables, which is basically money owed to them by other reinsurers, which also carries risk. That's the kind of baggage you often inherit when you buy older insurance operations.
So how did they deal with that? How did they mitigate it?
Well, they relied heavily on explicit indemnifications from the sellers, Scandia and Jan, basically promises that the sellers would cover certain pre-existing losses.
Okay.
And they also pointed to existing bad debt reserves they already had. So they bought growth, but they're upfront in the letter saying, look, we know we bought risk too, and only time will tell if the protections are enough.
Okay, this brings us right to the core financial engine. The investment portfolio just exploded. It grew 2.5 times to $4.1 billion.
Massive growth.
Investments per share jumped 107%. But, and this is the big but, if we look at where that huge $150.8 million in net income actually came from, here's the contradiction.
Yeah, this is the absolute aha moment if you want to understand the Fairfax model back in '96. You break down the earnings. And you find that the core insurance underwriting operations, the actual business of collecting premiums and paying claims, it resulted in a net loss.
A loss.
A loss of $50.6 million for the year.
Wait a minute. So they lost over $50 million actually insuring things, but they made record profits overall. How does that work? Is this just a hedge fund pretending to be an insurer?
Well, that's the perennial question, isn't it? Let's look at the key operational metric, the combined ratio. Fairfax's total combined ratio was 104.9%.
And anything over 100 means you're losing money on the underwriting, right?
Exactly. It means for every dollar of premium they took in, they paid out about $1.05 in claims and expenses. So overall, the basic insurance job, yeah, it was losing money.
Okay, so if the core business lost $50 million, where did the record profit actually come from?
Purely from the investment side of the house. Interest and dividends brought in a healthy $144 million, which is great.
Sure.
But the real driver, the powerhouse, was the $131.3 million in realized gains, selling investments for a profit. That's almost double the realized gains they had in 1995.
Wow.
So those investment gains alone more than wiped out the entire underwriting loss and then some.
So the investment strategy was strong enough to basically bail out the operational side. It is worth pointing out, though, the letter shows huge differences between the subsidiaries.
That's true.
The Canadian companies, like Commonwealth, were doing great. Stellar 87% combined ratio. But Ranger Insurance looks like a bit of a disaster at 123.5%.
Yeah, that difference is important. The profitable Canadian operations were masking some pretty significant issues elsewhere. And speaking of issues, management also noted a net reserve deficiency of $16 million, mostly driven by Ranger again. So definitely wasn't a perfect year operationally. The spectacular profit was really a function of, let's say, very astute timing in the capital markets.
Which is the perfect transition to the paradox we started with. They made an absolute fortune selling investments high in 1996.
Right.
But at the same time, they were sounding the loudest warnings about the market itself. It's like they were yelling, "Fire!" in a crowded theater while pocketing cash from selling tickets at the door.
That's a good way to put it.
Yeah.
Management openly said they were finding it really difficult to find long-term value in either the U.S. or Canadian stock markets. Why? Because things were just too expensive.
What specific red flags did they point to? Why should we care today that the S&P 500 PE ratio back then was around 18 times?
Well, to put that 18 times PE in context, they pointed out that number had only been higher in 4 years since World War II.
Okay, so historically very high.
Extremely high. They were essentially saying stocks were priced for perfection and, perfection doesn't usually last long in markets.
And then there's the really colorful bit in the letter, the historical parallel they drew. It's quite something.
Oh, yeah. This is memorable. They explicitly connect a July 1996 article in Reader's Digest called "You Can Make a Million" with the legendary August 1929 Ladies' Home Journal article titled "Everybody Ought to Be Rich."
Wow. That is not subtle. That's management basically looking at the market euphoria and saying, you know what this feels like, 1929? That level of public caution from a company that just delivered a 21% ROE is
almost
unheard of.
And crucially, they acted on that pessimism. Even with all this cash pouring in from selling investments, they slashed their common stock holdings down to near their lowest relative levels in 11 years.
How low?
Only 15% of their huge $3.5 billion portfolio was in common stocks. They were actively, deliberately reducing risk while it felt like everyone else was diving in headfirst.
Actively de-risking. And they kept running that nuclear bomb stress test you mentioned.
Yes, every month they simulated a simultaneous catastrophe. Stocks down 50%, preferred shares down 30%, bonds down 20%. That's not just a stress test. That's planning for an absolute market meltdown.
Unbelievable.
And just for good measure, almost like cheap insurance,
Yeah.
they bought a $1 million put option on the market, specifically linked to Odyssey Re, just in case things really did go south quickly, protecting their newest big acquisition.
This incredibly defensive behavior, it seems, enabled by the last piece we need to touch on, their culture and governance. The letter really emphasizes the structure, small head office, non-bureaucratic, and a team philosophy they describe as having no egos.
Yeah, and that culture, that non-bureaucratic, high-discipline approach, it's directly linked to their governance structure. Management explicitly credits their ability to stick to this contrarian long-term view to their dual voting share structure. That's the shield that lets them do it.
Okay, explain that. Why does that dual-class share structure matter so much, especially for the average investor looking at this?
Because it insulates them from short-term market pressures and, crucially, from hostile takeovers. The structure means management control isn't really threatened, even if the stock price takes a temporary hit like the kind of hit they seem to be expecting.
Ah, I see.
It allows them to be entrepreneurial, take that long view, and not constantly worry that a market downturn will make them vulnerable. They even cite examples in the letter, good companies like Nowsco and Morrison Petroleum that got taken over simply because their stock prices were temporarily low. Fairfax is essentially saying, we can ride out the storm because nobody can force us to sell the company when times get tough.
And that protection lets them stick to their really ambitious long-term goal, achieving a 20% return on equity and compounding book value at 20% annually, year after year, regardless of the market noise.
Precisely. And finally, look at their debt management. It just reinforces this cautious mindset. They lowered their net debt to equity ratio from 48% down to 41%.
Which is good.
But the really impressive defensive metric is the holding company cash. They had $101 million just sitting at the parent company level.
And they call this the survival ratio, right?
Exactly. That amount of cash, they calculated, could cover all their head office administrative costs and all their interest expenses for 4 to 5 years without getting a single penny in dividends from any of their operating subsidiaries.
Wow. 4 to 5 years of runway.
That is the definition of defensive positioning. It's a company built to survive, potentially even thrive through a multi-year economic winter.
So let's try and wrap this up. What does this all mean? The 1996 letter really paints this picture of profound tension, doesn't it? A year of incredibly aggressive, opportunistic expansion.
Yeah.
Perfectly balanced or maybe counteracted by this deep defensive investment posture driven by some serious market pessimism. They delivered record growth, but inside they seemed to be preparing for a depression.
The central contradiction, the thing that you, the listener, really have to grapple with is this. Those amazing 1996 results. They were completely driven by investment income and specifically those huge realized gains.
Right.
They essentially made their fortune that year by being incredibly smart or maybe just timely investors. Yet at the same moment, management was shouting from the rooftops that the very market gifting them these profits was dangerously overvalued and potentially on the brink of a major correction.
So the big question hanging over it all is, if your main profit engine is basically financial maneuvering in a market you deeply distrust and think is about to crash, well, how long can you sustain that kind of performance through just being careful? How sustainable is that model? That's the puzzle this critical year leaves us with.
Fairfax's answer, at least in 96, was clear. Slash stock holdings, build up that massive cash reserve that could last 5 years. I think the timeless relevance of this letter is that laser focus on, as they quote, the return of one's money, which is always prized in bad times. That message, I think, holds true today, regardless of what the PE ratio is doing this week. It really makes you consider the virtue, maybe the necessity, of preparing for the worst, even when you're delivering